Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in the last video we talked about six different ETFs that Sharia compliant, and we talked about why you should invest. If you are especially a new investor, why you should invest in ETFs, you know, how important it is to invest in ETFs, especially as a newcomer, especially with, you know, if you don't know anything about the stock market, this is your first time, you want to make sure you learn first. I would definitely recommend you guys to look into investing in ETFs first. And the last video we talked about six different, Sharia compliant ETFs that you can buy in the UK and the US or both. So have a look at that video before you watch this one. We talked about a lot of information about just at the beginning of that video, that's the importance of ETFs and why and so on. So watching that video first before you watch this one. This one is going to be a slightly shorter video. I'm going to talk about 7 ETFs. Straight away, we're just going to talk about the ETFs, and then I'm going to show you the performance. So for example, if you bought 100 shares for each of the ETFs that I'm going to talk about today, how much you would be up or down right now based on the basically 1 year returns. Now the issue with some of these ETFs is they are very new. Some of them are started October, November of last year, so for that reason they haven't been around for a whole year. So we just need to take that into consideration, and I will show you exactly the total returns for these ETFs, inshallah. This is what you see right now is my portfolio. I do have one ETF which I will talk about at the end, and last video I didn't want to make it longer than it was, so I didn't talk about what I will be doing. So moving forward, I'm going to tell you exactly what I will be doing with regards to ETFs and this portfolio, inshallah. Okay, now if you haven't joined us in the Patreon account, please do so. If you can, it will cost you 15p per day, and you get access to the Discord, you get access to all the buys and sells, and the Discord is actually full of brothers and sisters who are actually sharing good practices. So there's a lot of brothers and sisters on that account that are basically sharing really good practices, all the buys and all the sales, sharing good news about different companies and so on. And of course, questioning each other as well. So at times, why are we investing in this and what we invest in, and sharing their portfolios and so on. And I do exactly the same as well. I share all the buys and sells I make on regular basis. So join us if you can, inshallah. That will be absolutely wonderful to have you there. If you can't do that, just press that like button because it really helps the channel. Now let's get started. So the first ETF we're going to talk about today is SBUS. This is one of the ETFs that we've talked about before. It has expense ratio of 0.49. Total return in basically a year to date. So since the beginning of the year, sorry, not total return, year to date return is 11.65, which is quite nice. That's basically almost tracking the S&P 500 a year to date, which is really, really good. Distribution yield of 0.83%. So you get that in dividends. So this is based distribution in ETFs just means dividends. So you've got distribution, you've got accumulation. Accumulation is basically the fact that they reinvest it for you, which is actually quite nice, and we will see some of that in a second. And this one, you get that money. Now the issue with this one is I don't think it is actually available on ISA account in the UK, but please let me know if you can invest in this ETF outside an ISA account in the UK, because I think Interactive Brokers, it comes up but I can't invest in it. Is it because I'm using an ISA account, or is it available without using the ISA? So it would be interesting to know, please, if you can. Now, one of the issues I have with this ETF is the fact that a lot of the almost 12% comes from Microsoft and 9%. And before I move on, I want to say again exactly what I said in the last video, which is ETFs work slightly different. What they do is they take the entire ETF and then they apply the Sharia compliance side of things. So they're not really looking at individual stocks in terms of, like, Microsoft might be questionable, like for example Meta might be questionable, and so on, in Zoya's and Mustafa's or whatever. But they take the entire thing and then they of course do it like they treat it as just like a one stock rather than individual stocks. So just bear that in mind when you see this. So the fact that Microsoft is not maybe Sharia compliant in other platforms, but does not mean it will not be when they actually do their calculations here. So they'll do the 5% business side of things. They'll do the 33% in terms of interest-bearing debt, interest-bearing securities, and all of that stuff. So there you have it. That's the first one. Let's have a look at the second one. And the second one is SPRE. This is the REIT, Real Estate Investment Trust. This is, instead of buying properties, these companies buy those properties, they rent it, they do whatever they need to do, and they get that money. And REITs pay nice dividend of 4.3 Right now it's done absolutely nothing since the beginning of the year. The reason it hasn't done well is because REITs have not done well at all in basically since interest rates went up. Remember, the interest rates go up, REITs go down, because they can no longer, these companies can no longer go to the bank and get free money from the bank and then reinvest that by buying more properties and so on. So the REITs generally perform badly when it comes to when the interest rates are very high. When it was zero in 2020, in 2019, 18, 2020 and so on, these companies were doing really well. But right now they're not doing as well, of course. So 4.3% in terms of dividend yield, or in terms of distribution, and then you can see 52% of is the top 10, if you like. Now you can go to the website and have a learn more about the others, but I think there's about 20 stocks in this one. I can't remember exactly, but it's about 20 something stocks in this one, so it's not a lot. Right, let's now have a look at the rest of the ETFs. So now we're going to get into the HSBC ones. So let's slightly make it bigger. So you can see right now this one is emerging markets. So HSBC emerging markets, 0.35 is the dividend as the expense ratio, and then the dividend yield, there's no dividend yield, sorry, this is accumulation. So ACC is accumulation, so that means they reinvest that dividend for us. So rather than just, of course, taking it out, giving it to you, they will just reinvest it automatically for you. A year to date is about almost 9% up. And as you can see here, Taiwan Semi is actually 33% of this ETF, which is absolutely ridiculous. But 47% is just the top 10. So some of these companies, Al-Rajhis and Yuga Samsungs, they are still the same as they were before, but the weighting is really bad. Genuinely, look at the top 3 and then look at the rest. It makes no sense. So I get it, these two companies are absolutely huge, okay, when it comes to Samsung and Taiwan Semi, but make that about 7% and then distribute, but put the rest in. I don't know, it's doing okay, like 9%, almost tracking the S&P 500, so it's not bad at all. Emerging markets have been doing well, but it's just too much for one stock. And the next one is the HSBC World Islamic, again similar, so no dividends paid, 0.3 in terms of expense ratio, the year-to-date return of 5%, and the Microsoft is the top again, 18%, AMD, Salesforce, and so on. So only basically a lot of them, all they say is world. This, okay, let me see the top 10. So Novartis, Shell, SAB, and yeah, those are the only 3 that's actually outside the US. The rest of them are US based companies. 29%, so not bad. 29% is just and the rest that comes from the rest of the world. But this again, 18%. And now this is because of the index that trades is actually the weighting comes from that, but it's just too much. It's just one stock. It's really crazy. All right, so the next one that we're looking at is the Europe. So this is all the European companies. And as you can see, again, 0.3 expense ratio, year-to-date return of 2.6. Top 10 is here. So again, similar to some of the companies that we've already seen. Total Energies, for example, Real AP. I think this is Danish company. And Sonova, I think it's French. Liquids, I don't know this, maybe it's French. But as you can see, this is not bad. 5.6, 5.75, 4.4, 4.3. So this is better. I like this better than these distributions where you've got 20 plus 18% of the total. 42% is actually top 10, which is not bad either. The next one is Japan. So again, it's really nice the fact that you can actually buy Japanese indexes in the Sharia compliance side of things. 0.3, almost 7% up. So they're doing really well, and we know these companies. And look at again distribution side of things, the weighting. Almost to 7%, less than 6 point something, 5 point something, 5 point something, again all the way to 3.9, almost 4%, which is really nice. This is way better than what we've seen here. I keep saying this because it's important, because if this company does not do well, then it brings down the entire sector. If Microsoft tanks 20-30% this year, okay, which might be unlikely, but the rest of them, it will drag the entire ETF, so which is the reason I don't like. They might rebalance and whatever, but it's still not good idea. 30% of that is basically total holdings are from the top 10. And finally, we've got the US version of it. Again, 0.3, 5.4% year to date. And the top 10, again, Microsoft, AMD, Salesforce, 26%, 26.5% comes from Microsoft for this one. Then you got 4% Salesforce, 4% Tesla, 4% Adobe, 3% ExxonMobil, 3%, and then Cisco, J&J, Intuit, and Intel. So the rest are okay. I get this part, but I don't get Microsoft. And it's a lot to do with the index that they track and all of that stuff. So 43% comes from, again, the top 10. But yeah, so that's it. Now, some of these ETFs, okay, are very new. So like I said at the beginning, they all been around only for about 7, 8 months, 9 months maximum. So we're going to have to wait for about a year or so, 2 years maximum, to see what they like. The other thing I'm looking forward to is the day where this expense ratio becomes 0.0 something, because that's the day I will genuinely sell all my individual stocks and buy ETFs, inshallah. Because right now what's holding me back is the fact that these things are quite expensive, and some of them, you know, if the ones that even we looked at it before, you know, like this one here, 0.5 and then almost 0.55, which is quite expensive if when you look at it. So inshallah, hopefully, because remember the S&P 500, for example, the Vanguard ones, the VOO, for example, or SPY is 0.02, 0.04, 0.06. I think it's 0.06 for an SCHD, which has a nice dividend yield, all of that stuff. So hopefully one day this will come down. There will be more competition, and that will drive these things down, and for that reason, inshallah, we will be in a better position, and it's getting better. And you know, all these ETFs that you see right in front of you did not exist about 2 years ago. I think there might be 1 or 2 before, but majority of them didn't exist. So inshallah, things are getting better in the long run. So let's now have a look at performance side of it. So what I've done is I assume that they basically if they started in November, I'm just using November basically is when they came through the market, what they were trading at that point. So, or if they've been around more than a year, I've looked at what they were trading it for a year ago, and this is that. So the price you see here is the price they were trading at a year ago. If they are like 6-7 months around, that's the inception price basically. And I've bought 100 shares of these companies, basically of each one of the ETFs, converted. If they were US dollars, I converted them to pounds, of basically equivalent of that at the time. So this is basically my information. Again, this is not my portfolio. I'm just saying, giving an example of where you would be if you bought 100 shares of each one of these ETFs about a year ago, and so on. Now, as you can see here, for total return, okay, remember, all of them are ACC, which means they're not paying you dividends. They reinvest in that dividend for you. These two do pay dividends, so that's why you see basically some price in there. And look at this. So we would be down about £111, £112, £223, £140, £55. So all the HSBC ones, we will be down right now if we bought it about a year ago. Now the SPUS, if you bought 100 shares, £23 at the time, okay, you would be up right now £730, including tiny bit of dividends. And if you bought this one here, okay, you would be up, or you would be down, because of course the whole ETF is down, but you get £5 in terms of the annual income from dividend side of things. So that gives you about minus 23. Now you would have invested 11,738. 11,795 is where you would be right now. £59 is where you will be. That's £7 in terms of dividends. £66 up basically for the 1 year. So again, like I said, I'm looking forward to seeing what these ETFs do for the next year or so. So I'm not buying any of them. I'm just going to keep an eye on them and see how they go. Now, the ones that I'm genuinely interested in is, okay, these two would be really good if they were available in the UK inside our ISIS, but I don't think that's the case. So I'm just going to leave them alone. So what am I going to do? I do own one of the ETFs that I spoke about in the last video. So I will be buying more of this, inshallah, moving forward. I still like the iShares ones. So the iShares ETFs has also come down. They used to have a 0.5 expense ratio. Now it's 0.3. So I'm hopeful that it will come back down again, and they will rebalance it such a way that some of the stocks are now too much when it comes to individual stocks or whatever. So I'm keeping an eye on that. If the expense ratio come back down, I'll probably be buying 3 or 4 of these ETFs, inshallah, in the long run. and then sell some of the individual stocks here, so I don't have to do so much maintenance. Right now I have to keep an eye on 25 stocks here and another 10 something stocks in the other portfolio. So I'm doing all this manually, so this which is not great. In the long run, I want to make this as passive as I possibly can, and hopefully these ETFs will start paying some nice dividends, so I can get that as well. So yeah, there's a lot more into it, inshallah. But this ETF, I've neglected it. I really like it. I like the performance year to date. It kind of tracks the S&P 500. The expense ratio is not that too expensive. It's still expensive, but it's not crazy. So I'm gonna keep buying this bit of this, inshallah, in the next few months, and that's the only one I'm gonna keep buying. If I change my mind, I'll let you know as always, and I'm gonna be as honest and transparent as with you guys as I've always been. If you like this type of content, please like the video, subscribe to the channel. Let me know if you have any questions. I hope you're enjoying this. And the worst thing you could do right now is just just press that like button. That's all I want you to do. Forget about everything else. If you can't join us here, just press that like button, subscribe to the channel. Let me know if you have any questions. I'm going to stop here. Have a wonderful day. Assalamu Alaikum.